Hey everyone, I'm Emily Carter, and welcome back to Stock Stories. Today, we're diving into one of the most innovative software companies driving the global semiconductor revolution, Cadence Design Systems, ticker symbol CDNS. Its tools are literally what chip designers use to create the world's most powerful processors, from NVIDIA's AI chips to Apple's silicon. But here's the big question. At $350 a share, is Cadence still worth buying in 2025? Let's break it down. Cadence doesn't make chips. It makes the brains that help others design them. Its software suite, like Virtuoso, Palladium, and Protium, lets engineers simulate, verify, and optimize chips before they're ever built. From automotive systems to AI accelerators, Cadence's platforms are the backbone of digital innovation. And get this, the company works with every major chip maker in the world. So when you hear about the next big AI processor, chances are Cadence helped design it. Now, let's talk numbers, because that's where things get interesting. Cadence's revenue reached $5.1 billion with an 86% gross margin. That's elite-level profitability. Its net income sits around $1 billion, and it's been profitable every year for the past decade. But there's a catch. At a P/E ratio of 94 and a forward P/E of 50, Cadence is not cheap. In fact, its fair value estimate is around 283 years, meaning the current price implies about a 20% downside if growth slows. So investors here are paying a premium, betting on Cadence's future, not its present. Despite that high valuation, Cadence keeps delivering growth catalysts that justify investor optimism. In September 2025, Cadence expanded its partnership with TSMC, the world's biggest chip foundry, to support next-gen process technologies, N3, N2, and even the upcoming A16. It also launched an AI-powered dynamic power analysis tool with NVIDIA, capable of analyzing billions of chip cycles within hours. And if that's not impressive enough, Cadence announced a $2.7 billion acquisition of Hexagon's design and engineering division. This move brings in powerful mechanical simulation tools like MSc Nastran and Adams, used in aerospace and automotive design. Together, these deals solidify Cadence's position as a one-stop shop for chip and system simulation. But it hasn't all been smooth sailing. Earlier this year, U.S. Senator Tom Cotton raised concerns about Cadence's past dealings in China during the tenure of its former CEO, Lip-Bu Tan. The company agreed to pay $140 million to resolve export violation charges related to Chinese military universities. Now, while that's behind them, it's a reminder global chip politics can create real risk for companies like Cadence. So, what do the experts think? Well, most of them remain bullish. Top firms like Goldman Sachs, KeyBank, Berenberg, and Stifel all have buy ratings, with price targets between $390 and $405. Analysts forecast EPS growth of 15% annually through 2026. And get this, 14 analysts recently upgraded their earnings forecasts. So Wall Street's message is clear. Cadence is executing flawlessly. Let's compare Cadence to its peers, Synopsys, SNPS, and Fortinet, FTNT. Cadence leads in profit margins, holding an 86% gross margin compared to Synopsys' 81%. However, its valuation is the highest, with an EV/EBITDA ratio over 50, well above the sector average. So if you're buying CDNS, you're paying for excellence and for future dominance in AI-driven chip design. So, is Cadence a buy right now? Here's how I see it. If you're a short-term trader, the stock may be fully priced. But if you're a long-term investor, betting on the rise of AI, robotics, and semiconductor design automation, Cadence is one of the best plays in the industry. Yes, it's expensive, but it's expensive for a reason. It's building the digital world we'll all live in. So what do you think? Is Cadence still a buy at $350, or is it time to take profits? Let me know your thoughts in the comments below. Don't forget to like, subscribe, and turn on notifications for more in-depth stock breakdowns. I'm Emily Carter, and I'll see you in the next one.